You think your bank deposit is safe. You think that FDIC insurance means something. You think the government has your back when your regional bank goes under. Let me show you what I found this morning at 5:23 a.m. when I pulled the Federal Deposit Insurance Corporation's quarterly banking profile. And I need you to understand something before we go any further. This is not speculation. This is not fear-mongering. This is their data, published by them, verified by me, and what I'm about to show you is a mathematical impossibility masquerading as deposit insurance. The FDIC Deposit Insurance Fund balance sits at $150.1 billion as of September 30th, 2025. That number is public. You can verify it right now at FDIC.gov. The reserve ratio is 1.28% as of December 31st, 2024. Now let me show you the other number. Total insured deposits in the United States banking system exceed $10.7 trillion. Not billion, trillion. With a T. So let's do the math that your bank doesn't want you to do. $150 billion divided by $10.7 trillion equals 1.4%. The FDIC has 1.4% of the capital required to honor their promise to you. Your deposits are 98.6% uninsured by actual liquid reserves, and that assumes every dollar in that fund is real cash, which it's not. That 1.4% coverage I just showed you, that's actually generous, because I'm using the rosiest possible numbers. The FDIC's own data shows their reserve ratio hit 1.28% as of December 34, 2024. They're celebrating this as progress. Progress toward what? Mathematical fraud? Let me break this down in terms so simple that even a Federal Reserve governor could understand it. You walk into a bank. You deposit $100,000. The FDIC promises to insure that deposit, but they only have $1.28 backing every $100 of deposits. That's not insurance. That's a Ponzi scheme with federal backing. But here's where it gets obscene. The actual DIF balance is $150.1 billion. Sounds like a lot of money, right? Until you realize that Silicon Valley Bank alone had $175 billion in deposits when it collapsed in March 2023. One mid-sized regional bank had more deposits than the entire insurance fund. One bank. And when SVB failed, what did the FDIC do? They didn't use the insurance fund. They couldn't. The math didn't work. Instead, they invoked something called the systemic risk exception and went straight to the Treasury's printing press. Translation: they used your tax dollars to bail out uninsured depositors while telling you the system works. That's not deposit insurance. That's taxpayer theft with extra steps. Now, before YouTube's algorithm buries this video in the next 60 seconds, I need you to do something for me. I need you to hit that like button right now. Not later, not after the video. Right now. Because what I just showed you about the FDIC's 1.28% reserve ratio, that information is not going to show up on CNBC tonight. You're not going to see Jim Cramer calculating the real insurance coverage and tell his audience their deposits are sitting on a foundation of mathematical impossibility. Why? Because JP Morgan Chase doesn't pay for commercial time, so you can hear that the deposit insurance system is a fraud. Bank of America does not sponsor financial television, so you can learn that one regional bank failure could drain the entire insurance fund. The mainstream financial media is bought and paid for by the banks. Their biggest advertisers are the institutions that benefit from your ignorance about reserve ratios and systemic risk. So the only way this information breaks through the censorship wall is if you force it onto the algorithm's radar by smashing that like button. Do it now. Boost the signal. Because what I am about to show you next is going to make you question every dollar you have sitting in any bank account right now. We're going to dive into the $482 billion time bomb sitting on bank balance sheets, and why Stanford finance professors are saying it becomes quite bad at 5% interest rates. Hit like. Share this video. Because your financial survival might depend on this information reaching as many people as possible before the next banking crisis hits. Let me show you the $482 billion elephant in the room that nobody wants to talk about. U.S. banks are sitting on $482.4 billion in unrealized losses on their securities investments as of the end of 2024. That represents a staggering $118 billion increase, or 32.5% from just the previous quarter. $500 billion in losses hidden on bank balance sheets right now. But here's the magic trick that keeps this Ponzi scheme running. As long as banks don't sell those underwater bonds, they don't have to recognize the loss. They can classify them as held to maturity and carry them at face value on their balance sheet. So a bank can own a 10-year treasury bond that they bought for $1,000 in 2021 when rates were zero. Today, with rates at 4.5%, that same bond is worth $650 in the open market. But on their books, still $1,000. That works great until depositors start pulling their money out, because then the bank has to sell those bonds to raise cash. And the moment they sell, the loss becomes real. The capital vanishes, and the FDIC steps in. This is exactly what killed Silicon Valley Bank. They had to sell $21 billion in securities and realized massive losses, which triggered the bank run that ended with regulators seizing the bank 48 hours later. Florida Atlantic University's banking expert Rebel Cole warns the real risk is with regional banks holding between $10 billion and $200 billion in assets, as these banks rely heavily on uninsured deposits. If there's trouble, uninsured depositors may pull their money, which can quickly kill a bank. And Stanford finance professor Amit Seru told Fortune that at current interest rate levels, the banking system is seeing serious problems. It becomes quite bad at 5%. We're at 4.5% now. We're half a percentage point away from quite bad. Now let me explain why the Federal Reserve is trapped in the most impossible monetary policy position in modern history. They cannot raise interest rates any higher without detonating the banking system. At 5% interest rates, Stanford's Amit Seru says it becomes quite bad for banks. We're at 4.5%. They're half a point away from systematic bank failures. But they also cannot cut rates back to zero because that would ignite the inflation monster they've spent 3 years trying to kill. And now Trump's tariff policies are creating the perfect storm for stagflation, rising inflation combined with slowing economic growth. Private equity giant Apollo's chief economist warns that in a stagflation scenario, the risk is that rates will be higher for longer and credit losses will begin to accumulate. Here's the death trap. If inflation resurges because of tariffs and trade wars, the Fed has to keep rates high to fight it. But keeping rates high means banks continue bleeding on their $482 billion in unrealized losses. Eventually, some bank gets into trouble, depositors panic, and the cascade begins. If the Fed cuts rates to save the banks, they risk unleashing inflation that makes the 2021-2022 surge look tame. Food prices explode, energy costs skyrocket. The dollar gets crushed in foreign exchange markets. Either path leads to crisis. Either path leads to wealth destruction for anyone holding dollars in the banking system. The only question is which crisis hits first, the banking crisis from high rates or the currency crisis from low rates. And while Jerome Powell's term as Fed chair ends in May 2026, Trump is already signaling he wants someone more amenable to the Trump White House's low interest rate demands. That means the pressure to cut rates and risk currency debasement is only going to intensify. This is why smart money is already fleeing the dollar and flowing into assets that can't be printed, manipulated, or confiscated by central bankers. Let me take you inside the anatomy of a modern bank failure, because what happened in March 2023 is the blueprint for what's coming next. Silicon Valley Bank, March 10th, 2023. The 16th largest bank in America. $209 billion in assets. Gone in 48 hours. Here's what actually happened. SVB had loaded up on long-term bonds during the pandemic when rates were zero. When the Fed started raising rates in 2022, those bonds lost massive value. But as long as SVB didn't sell them, the losses stayed hidden. Then venture capital funding dried up. Startups started burning through cash. Depositors began withdrawing funds. SVB had to sell $21 billion in bonds to meet redemptions. They realized a $1.8 billion loss on that sale. That loss wiped out their capital buffer. Word spread. Bank run. Game over. Signature Bank followed 3 days later. First Republic collapsed 2 months after that. 3 major banks, all killed by the same mechanism. Underwater bond portfolios and uninsured deposit flight. Now here's the terrifying part. According to Florida Atlantic University's analysis, only 2 banks with assets over $1 billion currently have unrealized securities losses greater than their total equity. That's down from 3 in the previous quarter. Only 2 banks away from insolvency, out of over 1,000 banks with assets above $1 billion. Sounds good, right? Wrong. Because that does not count the 24 banks whose unrealized losses equal 50% of their common equity Tier 1 capital. When you lose half your capital buffer, regulators force you into remedial actions. Raise new capital, seek a merger partner, or face closure. And remember, these calculations were done when the 10-year Treasury yield was 4.25%, but rates have climbed back to where they were at the end of 2024, so that losses today would be back up close to $500 billion. The stress is building, the unrealized losses are growing, and all it takes is one bank to trigger depositor panic across the entire regional banking sector. Now, I need you to understand the legal structure of what a bank deposit actually is, because this is where it gets genuinely terrifying. When you put your money in a bank, you think the bank is holding it for you. But legally, that's not what happens. Under the Uniform Commercial Code, which governs all banking transactions in the United States, a deposit is classified as an unsecured loan to the bank. You are the lender. The bank is the borrower. And when you swipe your debit card or write a check, you are not withdrawing your money. You are calling in a debt the bank owes you, which means if the bank goes bankrupt, you're not a depositor with protected funds. You are a creditor standing in line with every other unsecured creditor, waiting for the bankruptcy court to liquidate assets and pay out pennies on the dollar. And this is not theoretical. This is codified in the Dodd-Frank Wall Street Reform Act of 2010, Title II, Section 210, the Orderly Liquidation Authority. This gives the FDIC the legal power to seize a failing bank, wipe out shareholders, convert bonds to equity, and, most importantly, confiscate deposits above the $250,000 insurance limit to recapitalize the bank. That's called a bail-in. And it's legal, it's the law, and it has already happened in the Western banking system. Cyprus, March 2013. The banking system collapses under the weight of Greek sovereign debt exposure. The Cypriot government, the European Central Bank, and the International Monetary Fund negotiate a bailout. But there's a condition. Depositors with more than 100,000 euros in Cypriot banks must contribute to the rescue. How much? 47.5%. They confiscated nearly half of all deposits above the insurance threshold to recapitalize the banks. No vote, no warning. You went to bed Friday night with 200,000 euros in your account. You woke up Monday morning with 105,000 euros. The rest was gone, converted to worthless bank equity. And the European Union called it a successful resolution. Not theft, a resolution. Dodd-Frank. Section 210 gives the FDIC the exact same authority on U.S. soil. When the next banking crisis hits, when the FDIC's 1.28% reserve ratio gets exposed, they won't just let the big depositors lose their money. They'll legally steal it to save the system. So if the banking system is sitting on a 1.28% reserve ratio, if $500 billion in unrealized losses are hidden on bank balance sheets, if Dodd-Frank gives regulators legal authority to confiscate your deposits, where does smart money go? It flows into assets that have zero counterparty risk. Assets that don't depend on the Federal Reserve, the FDIC, or any government institution keeping their promises. And right now, the biggest counterparty risk-free opportunity in the world is physical silver. Because silver is not just escaping the banking crisis, it's exploding higher due to its own supply emergency. Silver surged more than 150% in 2025, with prices hovering around $73 per ounce in early January 2026. This is not a typical cyclical rally. This is a fundamental repricing of silver as both an industrial necessity and a monetary metal. 2025 marks the fifth consecutive year of silver supply deficits, with demand reaching 1.17 billion ounces, while mine supply fell to just 835 million ounces. That's a shortfall of 95 million ounces in 2025 alone. For the period 2021-2025, the cumulative deficit reaches almost 820 million ounces, nearly a billion ounces of silver demand that couldn't be met by mine production. And here's why this deficit is permanent. Silver mine output peaked in 2016 at approximately 900 million ounces and has been declining since, falling to an estimated 835 million ounces in 2025. The decline comes from ore grade depletion, mine closures, regulatory challenges, and the fact that 71% of silver production comes as a byproduct from polymetallic gold, lead, zinc, and copper mines. Higher silver prices alone cannot incentivize new supply when most silver is mined accidentally. Meanwhile, industrial demand is accelerating. Solar panels, electric vehicles, data centers, semiconductors all require silver for conductivity. The International Energy Agency sees solar capacity quadrupling by 2030. Each solar panel requires approximately 20 grams of silver. Do the math. Quadruple solar capacity equals quadruple silver demand from just one industrial sector. But the real catalyst for silver's explosion just hit on January 1st, 2026. Starting January 1st, 2026, China implemented new export restrictions on refined silver that are sending shockwaves through global markets. And this isn't just another trade policy tweak. This is a supply shock that's turning a long-term silver shortage into an immediate global crisis. Under the new policy, only large state-approved companies are allowed to export silver, and only after obtaining special government licenses. To qualify, firms must have an annual production capacity of at least 80 tons of silver. These requirements effectively block hundreds of smaller and mid-sized exporters who have served as key suppliers to global industrial users for decades. China produces roughly 13% of global silver supply. When you cut off access to 13% of any critical commodity, prices don't just rise, they explode. And the explosion is already happening in real time. In Shanghai, physical silver is now trading above $80 per ounce, while COMEX futures remain much lower in the 30 to 35 range. Let me repeat that. Physical silver in Asia is trading $45 to $50 higher than paper silver contracts in New York. That's not a premium. That's a complete market breakdown. The paper silver market is pricing in fantasy supply that doesn't exist. The physical silver market is pricing in reality. There's no metal available at any reasonable price. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. This is what happens when the paper market collides with physical reality. When futures contracts written in New York meet Chinese export licenses that don't exist. When industrial demand meets empty vaults. The divergence between Shanghai and COMEX prices is telling you something critical. The era of paper price discovery is ending. Physical delivery is becoming the only benchmark that matters. What you're witnessing right now is the complete structural breakdown of the paper-silver market. And when I say breakdown, I mean the entire pricing mechanism that's controlled silver for decades is collapsing in real time. Shanghai physical silver trading above 80 per ounce, while COMEX futures sit in the $35 range, is not just a price divergence. It's proof that the paper market has lost all credibility as a price discovery mechanism. Here's how the scam worked for decades. Banks and trading houses would sell silver futures contracts on the COMEX promises to deliver silver at a future date. But most of those contracts never resulted in actual delivery. Traders would cash settle or roll their positions forward. The paper tail wagged the physical dog, but now physical demand is calling the bluff. Silver lease rates spiked above 5% in September 2025 for the fifth time that year, well above historical levels of near zero. When lease rates spike, it means holders of physical silver are demanding massive premiums to lend their metal. That only happens when there's genuine scarcity. Current indicative premiums from major dealers show 1,000 OZ silver bars at spot plus 5.99%, 100 Oz bars at spot plus 10 to 12%, and 1 Oz silver coins from spot plus 12%. These aren't normal market premiums, these are shortage premiums. You can see the paper price on your screen showing silver at $35, but try to buy actual silver today. You'll pay $40, $42, maybe $45 depending on the product. The physical market is already pricing in scarcity that the paper market refuses to acknowledge. Bloomberg reported that silver inventories at the Shanghai Futures Exchange hit their lowest level since 2015. Meanwhile, COMEX registered inventories, the silver available for delivery against futures contracts, continue their relentless decline. And here's the mathematical reality. If even 5% of COMEX silver contract holders demand physical delivery instead of cash settlement, the exchange runs out of silver. The entire paper market implodes overnight. That's not speculation. That's arithmetic. And with China choking off 13% of global supply, the arithmetic is about to get very ugly for anyone holding paper silver instead of physical metal. Now, while silver is exploding due to physical scarcity, there's another massive wealth transfer happening in digital assets, and this one is being driven by the most pro-cryptocurrency administration in U.S. history. Bitcoin, XRP, and Solana are positioned for potential 5x gains as Trump delivers on pro-crypto promises, with regulatory clarity accelerating institutional adoption through 2026. Here's what changed everything. Bitcoin ETF inflows totaled $23 billion in 2025, and stablecoin legislation became law under the Genius Act. But that's just the foundation for what's coming in 2026. President Trump signed an executive order directing the creation of a working group to propose a comprehensive federal regulatory framework for digital assets and evaluate the potential for a national Bitcoin stockpile within 180 days. A national Bitcoin reserve, not just institutional adoption, sovereign adoption. When the U.S. government starts buying Bitcoin for strategic reserves, every other nation has to follow or risk being left behind. Texas already approved a state-managed fund, holding $5 million in Bitcoin ETF shares, with plans to invest an additional $5 million directly in Bitcoin in 2026. Arizona and New Hampshire passed similar legislation. This is the beginning of a state-by-state Bitcoin reserve movement. Bitcoin ETF assets under management are expected to reach $180–220 billion by year-end 2026, up from approximately $120 billion currently. That's not retail speculation. That's institutional capital flowing into a finite asset with a hard cap of 21 million coins. Meanwhile, the regulatory clarity that's eluded crypto for years is finally arriving. The Digital Asset Market Clarity Act passed the House with bipartisan support, with Senate floor vote expected in Q1-Q2 2026. Over 100 new crypto ETFs are anticipated to launch in 2026, including 50-plus spot altcoin products, following the SEC's approval of generic listing standards. This is the institutional legitimization of digital assets. when pension funds can buy Bitcoin ETFs, when banks can custody crypto, when regulatory clarity removes legal uncertainty, the floodgates open. Now let me show you exactly what happens when these three crises, banking system collapse, silver supply shortage, and crypto institutional adoption, converge into a single wealth transfer event. Because what we're witnessing is not three separate stories. It's one mathematical inevitability playing out across multiple asset classes. Let's model the depositor flight scenario. Assume just 10% of US depositors lose confidence in the FDIC's 1.28% reserve ratio and decide to move $25,000 each into physical assets. Just 10%. There are roughly 130 million households in America. 10% is 13 million households. 13 million households times $25,000 equals $325 billion in purchasing power fleeing the banking system. Where does that money go? It can't stay in banks. That's the risk they're fleeing. It can't go into treasury bonds. Those are what created the $482 billion in unrealized losses. It flows into assets with zero counterparty risk. Now let's divide that $325 billion, $200 billion into physical silver, $125 billion into Bitcoin and crypto. For silver, $200 billion divided by current price of 73 per ounce equals 2.7 billion ounces demanded. But remember, global mine production is only 835 million ounces per year. And COMEX, London, and Shanghai inventories are already depleted by 70%. Where do 2.7 billion ounces come from? They don't exist, so price must rise until demand is destroyed. At $150 per ounce, you cut demand in half to 1.3 billion ounces, still more than annual production. At $300 per ounce, you're down to 650 million ounces, finally below mine supply. That's the equilibrium. $300 silver, and that's just 10% of depositors moving $25,000 each. For Bitcoin, $125 billion in new demand hits a market cap of roughly $1.8 trillion. That's 7% additional buying pressure on an asset with fixed supply. Bitcoin ETF assets under management are already expected to reach $180 to $220 billion by year-end 2026. Add depositor flight, and the path to $400,000 and $500,000 Bitcoin becomes mathematically inevitable. But here's the feedback loop. As silver and Bitcoin prices explode, more depositors panic. The 10% becomes 20%. The $25,000 becomes $50,000. The mathematical progression becomes exponential. This is not prediction. This is what happens when finite supply meets unlimited demand driven by loss of confidence in the banking system. So now that you understand the mathematical impossibility of the FDIC's 1.28% reserve ratio, the $482 billion in bank unrealized losses, the silver supply crisis, and the crypto transformation, let me tell you exactly what you need to do to protect your wealth. This is not financial advice, this is survival strategy. Because when the system breaks, it breaks fast, and there won't be time to adjust your position. Go to your bank today. Not tomorrow, not next week. Today. Pull out enough cash to cover 3 to 6 months of essential expenses. Keep it in a home safe, not in the bank. When there's a bail-in, when banks freeze withdrawals under emergency powers, you need operating capital that's completely outside the banking system. Take 15-25% of your investable assets and convert them into physical silver. Not silver ETFs, not silver mining stocks, not paper silver contracts. Physical silver coins and bars that you can hold in your hands. Buy American Silver Eagles, Canadian Maple Leafs, or 100-ounce bars from reputable dealers. Yes, you'll pay $8 or $12 over spot price. That premium is insurance against counterparty risk. With silver heading toward 100 plus per ounce, a 15% premium today is noise compared to the upside potential. Allocate 10-15% to Bitcoin and established cryptocurrencies with regulatory clarity. With Trump's pro-crypto policies and institutional adoption accelerating, Bitcoin could reach $400,000, $500,000 if everything aligns. But only invest what you can afford to lose in the short term. Use regulated exchanges, move crypto to hardware wallets, and never leave large amounts on exchanges. Remember, not your keys, not your crypto. Physical assets must be stored outside the banking system. Home safes bolted to concrete foundations. Safety deposit boxes become part of the bank's bankruptcy estate if the bank fails. Precious metals storage facilities are better than banks, but home storage gives you immediate access during crisis periods. Don't keep all assets in one country or under one legal jurisdiction. The U.S. confiscated gold in 1933 with Executive Order 6102. They could do it again with silver or crypto. Having assets in multiple jurisdictions provides options if any one government decides to seize private wealth. This is not paranoia. This is preparation for mathematical inevitabilities. 14. Now I want to stop right here for a moment because I need to talk to you about something critical to your financial survival. The information I just walked you through, the FDIC's 1.28% reserve ratio, the $482 billion in bank unrealized losses, China's silver export restrictions driving Shanghai prices to $80, while COMEX sits at $35, Bitcoin ETF inflows hitting $23 billion, and Trump has crypto transformation. None of this is going to show up on mainstream financial television. You're not going to see CNBC calculate the mathematical impossibility of FDIC deposit coverage. Bloomberg is not going to explain why physical silver is trading $45 higher than paper contracts. Fox Business isn't going to tell you about the convergence of banking crisis and hard asset scarcity. Why? Because their advertising revenue comes from the banks and financial institutions that benefit from your ignorance. JP Morgan Chase doesn't pay for commercial time, so you can learn that your deposits are legally classified as unsecured loans. BlackRock does not sponsor financial shows, so you can understand why their Bitcoin ETF is seeing massive institutional inflows. The mainstream media's job is to keep you calm, keep you uninformed, and keep your money trapped in their system until it's too late to escape. So the only way this information reaches the people who need it is through independent channels like this one, which means we are 100% reliant on you. Not sponsors, not advertisers, you. If this analysis helped you understand the mathematical realities of the banking crisis, if it showed you why smart money is fleeing to physical silver and crypto, if it gave you an action plan for protecting your wealth, I need you to hit that super thanks button below this video. You'll see a heart icon underneath. That's the super thanks feature. It costs less than dinner for two, but it keeps this research alive. It keeps me pulling Federal Reserve reports at 5 a.m. so I can bring you the data Wall Street doesn't want you to see. And if you want to join the core group of people preparing for what's coming, click the join button next to subscribe. That makes you a channel member. You get early access to videos, members-only live streams where we dive deeper into the data. And most importantly, you become part of a community that refuses to be financially blindsided. Because what we've covered today is not theoretical anymore. The FDIC reserve ratio is 1.28%. China implemented silver export restrictions on January 1st. Trump signed executive orders for a national Bitcoin stockpile. The mathematical inevitabilities are playing out in real time. The only question left is whether you'll be positioned for the wealth transfer or caught unprepared when it accelerates. Hit super thanks. Join as a member. Share this video with everyone you care about, because the next banking crisis isn't coming. It's here. And your financial survival depends on acting before the math becomes undeniable to everyone else.